Hello everyone, and welcome back to another valuation video. Sorry I've been a little lax on these for the last couple of weeks. I know I said 2 weeks on these videos, and apologize for that, but I wanted to do some more research on this. Thanks to everyone who's given me some suggestions on companies. One of the suggestions was McDonald's, another one was Corning. I dug into them a little bit, and I didn't want to get into McDonald's yet because I just did a General Mills valuation, and I saw McDonald's as pretty similar, and I had similar thoughts on their business model and where they were going. So I didn't want to do two in a row like that, but I thought McDonald's is interesting, and I'm going to keep them in mind down the road. Uh, so instead of doing that, and I think I wanted to do a company that I've kind of looked at for a while, and it's a company that I don't use their products, but I wanted to see how good they were as an investment. So today I'm going to talk about COH Inc. COH is a manufacturer or a designer of accessories, handbags, footwear, jewelry, travel bags, watches, all types of fashionable products that are out there. They're a well-known brand. They've been around since 1941, and they have a strong brand presence out there in the fashion industry. They're on par with Ralph Lauren and Calvin Klein and Coco Chanel, and those brands have been around for a long time, and they have a certain status to them. So I wanted to go through this one because I've looked at it for a while and see how they do as an investment. I obviously am not one that uses handbags very often. However, my wife seems to think that they are a great thing to shop for constantly. And there's obviously a big market for it. So I wanted to see if COH was a good investment or not, and I want to take you through that. So why don't we start with some charts? People had asked for a little more visual on these valuations, so I'm going to go through this a little bit quicker than I normally do, using the charts here. So the first chart I have up here in the old school spreadsheets, you can go to these charts and you can select them and you can change them around and pick various different items in here. So I've set these up as the things I think are most important, and as you watched a couple of my videos, you notice I focus on a couple things in my valuations that I find to be important. Free cash flow. How's their free cash flow looking over time? So since 2003, they've grown their free cash flow from 164 million to almost a billion, 948 million dollars per year in the trailing 12 months. And you can see from this chart, it gives you a nice visual of it's pretty steady growth. It's gone up almost every year. The only little dip is this 2009 era, which, as we said before, was that economic downturn we had where everybody was having troubles. So you can kind of give them a little bit of a pass here, especially being a higher end product. People will scale back on those first, so that's one of the risks that we'll take into account later. But you can see that they've grown free cash flow year over year over year over year pretty consistently. They kind of leveled off here in the last 12 months, but it's been a pretty steady growth. I like how this curve just is consistent. Same thing on the owner's earnings side. I mean, in fact, owner's earnings is even more consistent. That dip here in 2009 is not nearly as severe, and it consistently recovers up here. So it looks like owner's earnings and free cash flow are pretty stable, and they're pretty stable in their growth. So I like that. This is the stock price. I don't want to take this into account too much until we're looking at where do we get in on the company. I'd rather look at the value of the company first and then go into how much is the stock price. So it's kind of like Buffett says, read the annual report without knowing what the valuation is. Do your valuation so it's not biased, and then go from there. Sorry. If we go over to earnings per share, diluted earnings per share, very steady growth. That's almost a straight line going right up from 2003 up to recently. So their earnings per share is growing very consistently. You gotta like that. It's very stable. We don't have a lot of peaks and valleys here. Free cash flow to sales. So as sales grow, are they increasing their free cash flow, or are they maintaining their free cash flow? They're not gaining sales that aren't earning them the same margin. They're not just getting sales to get sales, which can be a bad sign out there. Look at free cash flow to sales. It's pretty stable. There's some ups and downs, but all in all, it looks like for every sale they make, their free cash flow is pretty steady. In fact, it's going up. So that's a good thing that they are benefiting from economies of scale here. From 2003, it was 14.5%. They've gone up to 22, 21% now with their free cash flow per sale. I like that. That's good. Price to free cash flow, again, that's a marker of how the market values their free cash flow number. So as free cash flow has been steadily increasing, the price per dollar free cash flow has been kind of declining a little bit. It's been going down a little bit here to about 14, and kind of getting near that market rate. So it's not considered a growth company as much as it was back in the early 2000s. So it's a value play now, as I think it should be, a company from 1941, and that brand loyalty it's been around for a while. So I would see them as a well-established brand trying to grow nice and steadily. They're a value play and not a growth story as much. Cash return on invested capital. I really like this not just the chart but the numbers here. They were at 61%, 50%, 39, 65. I mean, these are really high numbers. So the cash return we're getting on the capital we need to invest in the company to generate these earnings and these free cash flow, it is very minimal. We're getting a very nice return on the cash we're getting throughout the years. Even in these down years, it's still really, really high. This cash return on invested capital is a very nice metric to show how much return we're getting. And that makes sense because they're not a manufacturer of these products. They're more of a brand manager. So they're the ones that design the products and then give the specifications on how to manufacture these products. And they're really managing the brand. They don't have those high overhead costs that a manufacturing facility does. They really just manage the brand and make sure that the quality is up to the standard. So they're going to have a high cash return because they don't need a lot of fixed assets to generate their sales. So we're going to see this number be very high, and seeing it very high consistently is a nice thing to see. Return on assets, as I said, they don't have that many assets. They have stores, but they don't have a lot of the manufacturing side, which means their asset base doesn't need to be as high for their returns. So 23%, 25%, all the way up into the 30s, they're generating a little bit higher return on their assets even, which is a nice thing to see. And we would expect this to be higher because they don't have that fixed asset base, which is extremely nice. Their costs should be highly variable based upon inventories, and not based upon trying to overcome that hurdle of having high fixed costs. So return on equity, again, very high. You can see that it's moving up, and it's pretty much the same as return on assets, which we'll get into in a little bit. But their return on equity is very high. It's always been above 30, and it's getting up into the 50% range, over 50% range in the last couple of years. Very nice return on equity here. What about gross margins? So in this industry, in the fashion industry, it's very competitive. There are a ton of different brands out there. There's a ton of different products you can buy. I couldn't even name how many different types of handbags there are out there, jewelry and footwear and watches. So you would think in a highly competitive marketplace, you would see a very low gross margin. They would have to compete on price. Pricing would be a main driver of their business. However, in the fashion industry, it's a little bit different. Sometimes price is actually a benefit, and being perceived as expensive and being a status symbol is actually a good thing for your business. And fashion is certainly that type of industry, obviously, because people want to seem like they're wealthier than they are, and have these products that they're considered high-end products, and price is a main factor in that. So seeing a high gross margin in this industry is very nice. Look at the 70s, constantly in the 70s, very consistently in the 70s with gross margin. So what about net profit margin? Do they have a lot of overhead that they need to overcome here? So even though they're in the 70s here, it looks like they still have a pretty nice net profit margin. They're still in the around 20% range. They get down in the 15s, but they're pretty much in the 20s pretty regularly with their net profit margin. Again, that's very nice. They are able to generate profit on the products they've made, and it's a testament to the brand. In this industry and in the fashion industry, brand is everything. being considered posh and being a high quality business is absolutely paramount to even making the business successful. If you are not considered a high-end brand, you lose very quickly. And I think a good example of that, if I'm recalling from my childhood, is maybe Bugle Boy. Maybe that was considered the cool brand when I was a kid for kids' clothes, and they fell by the wayside, and I have no idea where they are now. But the point being, if your brand falls off, your whole business falls apart. So seeing this profit margin, seeing that they're able to maintain their brand and consider themselves high-end and not having to compete on price is a very nice sign that the Coach has a well-established brand, and as brand managers and not manufacturers, that's a positive for management. So what about CapEx? Again, we said they don't have a lot of they don't have any factory costs, but they do have some CapEx, and we can see CapEx is actually gone down over time. So what is this CapEx? This CapEx is mainly them building new stores. It's growth CapEx. So they're going out, they're renovating some of their stores, changing formats, but mostly it's growing their store base and getting the number of outlets that are out there more available. So I looked at their 10K, and you look at their retail stores. In July 2010, they had 342 stores, 345, and now 354. Not too many stores out there compared to like a Bed Bath & Beyond or a Target or anything, but you can see that they're opening more and more, a couple stores every so often, which is a nice thing to see. That's not before. So you can see this CapEx is actually going down as they're opening stores, which is nice when we see free cash flow going up here. When we see free cash flow going up and up and up and up, but CapEx is going down, they're not having to reinvest a whole lot to grow that free cash flow, which is a nice thing. Inventory turnover, this is critical. How quickly are they getting those products in and getting them out? It looks like it's pretty stable. I think it's just going in, it's coming out. They've done a very nice job of doing inventory management here. So it's a nice stable system that they have going on. They're managing their inventory well. They're not getting stockpiled. We can see it's creeping up a little bit, but it looks like it's still pretty flat. Current ratio, again, I like liquidity, and I like nice solvent companies. So we look at their current ratio. Very, very nice. They have a current ratio of over 2 very consistently, so they've got the assets to pay off their liabilities. They're not going anywhere in the near future. And what about their quick ratio? How's that doing? Again, very nice ratio they have here. Well over 1, almost over 2 in a lot of cases, over 3 in one case. So they've got the current assets. This is a very safe company from a liquidity perspective. They have the assets to pay their debts. They're not going to be in any financial distress in the near future. So I like to see that. And what about debt to equity? So their debt to equity, 44% debt to equity, very, very low here. It gets up to 63% of equity here. So it's pretty safe. And when we go into the statements, we'll look more into what this debt makes up, because I think how their debt is set up is much more important than the fact that they have debt. And then free cash flow to debt. Do they have enough to pay off their total debt? Do they have enough free cash flow to pay off their debt? Look at this free cash flow. 72% of their total debt they have in free cash flow every year. So they have the ability to pay off their debts. And again, when we look at this debt ratio over here, it's important to note that we said they have a very small asset base for their business. So debt is obviously going to make up a significant portion of their equity, because they have fewer assets just in whole in their business. They're churning assets through. Inventory is coming in, it's going out. It's coming in, it's going out. It's very, very, very quick, and their assets they have are assets that they're selling in the future. So seeing this debt to equity ratio is higher than I would normally see in other businesses is kind of okay because of how it's made up. And we can see that their free cash flow is more than covering their debt load. They have enough free cash flow to pay off their debts in almost a year and a quarter in most cases, and in